Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at something unusual, an all-weather portfolio. So this is a portfolio from a client who kindly agreed us to let us share that, and it aims to provide basically absolute positive returns in different kind of environments. This might be when inflation is going up or down, when GDP growth is positive or negative. And it does that by using leveraged equities and by allocating quite significantly to diversifying strategies. So if you look at the holdings, we can see that the largest allocation is to this leveraged equity ETF that provides, I think, 2x exposure to the S&P 500, which is the 50% weight. Thereafter, we see an allocation to the AQR Equity Market Neutral Fund, gold, and thereafter followed by a little bit more gold and primarily managed futures funds. Now, this portfolio is expensive with 93 basis points. So let's investigate if it's been worth paying so much for this portfolio. The portfolio only has a track record going back to 2019, simply because some of the funds have been launched that year. But what we can see that the performance of this all-weather portfolio versus the benchmark that we selected, which is an 80-20, 80% equity, 20% bond portfolio, that it has significantly outperformed that. We do see that it's been more volatile as well, had a higher drawdown, but given that the return has been significantly higher than that of the benchmark, its Sharpe ratio is also significantly higher with 0.89 versus 0.61. If we compare the all-weather portfolio versus the benchmark from an asset class perspective, we do see that if we use the holdings, i.e. the funds, that this looks like a little bit of equities in here, both have fixed income, and then the all-weather portfolio has a bit of commodities, cash, and other. Having said that, the normal data providers like Bloomberg, Morningstar, whatnot, they often label alternative funds incorrectly. So for example, a managed futures fund might be labeled as a bond fund because it primarily holds US treasuries for cash management. Better is a risk-based approach. And here we really do see what are the underlying exposures from a return risk perspective. And we see that the primary risk in both cases is just equities. The all-weather portfolio has a little bit of commodities and equity factor exposure. This is from the AQR Equity Market Neutral Fund, and also a decent amount of unexplained risk as expected. We can move on and question if this portfolio has been constructed thoughtfully. And what we're going to do is look at a correlation analysis. So here we see the correlation of all the funds of this all-weather portfolio. And what we want to see is that most of those funds should have low correlation, indicated as green numbers. So we want to see more green than red. And in fact, that's exactly what we see. Almost all of those funds are lowly correlated to each other, which is great because that means they can provide diversification benefits. The only fund that is worth singling out is the Standpoint Multi-Asset Fund with the ticker BLNDX. And we can see that has a large allocation to equities, as well as a large allocation, not large allocation, large correlation or high correlation to equities, as well as to managed futures fund. And that's because it effectively combines equities and managed futures, but so does this portfolio. So having this fund and this portfolio doesn't make much sense. It's just providing the same exposures again and should be removed, which also makes asset allocation simpler. We can also look at the risk profile of this all-weather portfolio versus 80-20 benchmark. And if you look at the significant drawdowns of the last 6 years or so, we do see that that all-weather portfolio performed worse during COVID in 2020. That's primarily because of the equities portfolio that is levered, and also because the managed future strategies don't provide protection against short market declines, more against bear markets, and COVID was a very short bear market. Having said that, in 2022, the all-weather portfolio is significantly better. than the benchmark portfolio simply because it was short bonds at that point in time. And the benchmark portfolio, of course, was long bonds, right? And therefore you see the overall portfolio having a much lower drawdown. Now, usually at this stage of the analysis, we ask the question if this portfolio can be simplified. But the funds in the portfolios are relatively uncorrelated. So there's not much we can simplify. You could theoretically take some of the managed future funds, there's a lot of them in this portfolio, and replace them with one single position. For example, DBMF acts almost like a passive exposure managed futures. You could do that. On the other hand, it kind of diversifies manager risk, right? But the one thing we can do is look at, are there any funds that provide a similar exposure to this portfolio? There's only two names that come to our mind. The first one is the return stacked US stocks and managed futures ETF, RSST, which combines equities plus managed futures, and of course the Standpoint multi-asset fund, which again is equities plus managed futures. The only issue is that RSST was launched only about a year ago, so there's not much data we can analyze here. The track record is not meaningful from that perspective. And of course, both of those funds are less diversified. There's no gold, there's no equity market return here, and they are more expensive. So from simplification perspective, we're going to pass. The other aspect that's kind of interesting to think about is what would optimization show? Now, in general, investors should be very cautious of optimizations, because if you optimize for something like Sharpe or return or whatnot, the out of sample results, i.e. what you achieve in reality, often is significantly below what you get in sample. Having said that, what an optimization is useful for is to provide food for thoughts. And it often shows you what allocations might have made sense, and perhaps that we shouldn't be too aggressive on some positions and perhaps too conservative on others. So we're going to do a very simple Sharpe optimization. This is an unconstrained one. So I'm not going to put any constraints for minimum K or volatility. I'm just curious what a raw optimization would do. And what we see over here is kind of interesting, that the allocation to the leveraged equity ETF goes basically almost close to zero. The allocation to the AQAR equity market fund gets boosted significantly. We do increase allocation to gold, and we kind of almost sell off all the managed futures fund and consolidate the one, which is one product from Campbell, the systematic macro fund, which is interesting to think about. And so that warrants further investigation why the optimization would have done that. The Sharpe would have increased from 0.73 to 1.5, right? And so here are some thoughts in terms of how this portfolio, from an allocation perspective, could be improved. Now, this concludes our short analysis of this all-weather portfolio. As mentioned, it's kind of innovative in the sense that it uses leverage equity to pretty much provide the same exposure as the S&P 500, but then uses the remaining allocation to allocate to diversifying strategies. The choice of diversifying strategies is great because it includes primarily uncorrelated ones, equity market neutral, managed futures, a little bit of gold. You could optimize this further. As mentioned, there's some unnecessary funds beyond the X in here, but broadly speaking, kind of an interesting approach to thinking about non-traditional asset allocation. Hope this helps. Have a nice day.